Good evening, everyone. Time for another silver update. Now, this is the daily chart of the Dow Jones Transportation Average, and you can see the radical move that we have here. But before we get to this and do some analysis, let's take a look at this VIX. We're going to look at the VIX tonight, and we'll start with the Wikipedia article. And VIX is a trademark ticker symbol for the Chicago Board Options Exchange Market, and it's the volatility index. It's a popular measure of the implied volatility of the S&P 500 index options, often referred to as the fear index or the fear gauge. It represents one measure of market's expectation of stock market volatility over the next 30-day period. So keep that in mind. It's a 30-day period that we're talking about. Now I'm going to try to prove to you that this whole thing is complete nonsense. But just to explain to you how this thing works is that if you remember, the long-term capital management was actually formed by one of the guys, Black-Scholes. I don't remember which one. But anyway, the Black-Scholes model for option pricing. You know how options work. Options are based on time decay and volatility. So an option is the right to buy. It's a derivative of something. In the case of stocks, it's a derivative of stocks. So it's a right to buy or sell. A call is a right to buy. A put is a right to sell a particular security at a given price expiring at a certain time. So traders and people who have to take the other side of these things, and whenever you buy a put, then someone has to open a call. There's one for one on these. There's always another person on the other side of the trade. So they have to gauge how they're going to price these things, and they have to offset their risk. So the VIX is going to be a big key to that, because the price of stock options and other options, futures options, it doesn't matter, all options are based on volatility, based on this Black-Scholes model, which is the idea that volatility of the market is what helps you price these options. So hopefully I can flesh this out a little bit more when we look at the Zero Hedge article. And this is pinned on Zero Hedge. The VIX has never done this ever before. Never in the history of the VIX, the so-called fear index, has this ever happened before. The last 3 days have seen the VIX drop by 12.74%, 15.55%, and 13.4% today. VIX has never dropped more than 10% for 3 days in a row, ever. Now, we all know what happened. The Fed blinked, basically. And they put one of their minions out there. I don't remember if it was Bullard or whoever it was. They came out and started talking about QE4, and then they ramped the stock market. So let's look at the VIX and what actually happened. This is the Yahoo chart of the VIX on top of the S&P 500. So you can see we're on the 5-day, and you can see it goes back to Wednesday of last week, and the percentages are shown here. So since last Wednesday, the S&P 500 is up 2.24%, and the VIX is down 30%. So here's what Tyler's talking about here, this tremendous drop in the VIX. Now, the question you have to ask is this an accurate index? In other words, is it an accurate way to price stock options? Now, I'm going to argue that it's not. But I'm going to use the transports, the Dow transports, to give you an idea of how this thing works. So for most of you, you don't play stock options. It's not something you're interested in, and really only it's for the gamblers of the gamblers. But it's important to understand these concepts, to understand what's going on in these paper markets. Now, these options are priced upon the implied volatility. Implied volatility means the potential for very, very big moves in the future. Now, if you've ever read Market Wizards, which is one of the classics, I recommend that book. There's Market Wizards 1 and 2. Market Wizards, the first one, is the one that has interviews with Jimmy Rogers, Ed Seykota, Paul Tudor Jones. I mean, the big wigs, big wigs, and this is right after the 87 market crash. And they talk about implied volatility. One of the things that was pointed out, I think it was in the Paul Tudor Jones interview, was that the movement in the market was so dramatic in 1987 on Black Monday, I believe it was. I think this is when the Dow dropped 500 points in one day. You got to remember, this is a Dow that's only around 2,000, 2,200. It hit a high of 2,700, came down to around 2,200, and then did that drop of about 500 points. So huge percentage loss. Now, based on implied volatility, I think it was Tudor Jones pointed out that the calls on that Black Monday, the same price calls that were there before the market opened, the price of those calls went up when the market was down 500 points. And that's because of the implied volatility. In other words, the range expansion in the market was so great. To give you kind of an anecdotal way of thinking about this, well, if the market could be down 500 points today, it might be up 1,000 points tomorrow. That's the kind of idea that's behind that. So let's bring it to today's market here. You can see this blue candlestick, and this is a solid blue candlestick. That is very bullish on the transports. But you can also see that that candlestick is larger than every candlestick until back to this one back in January. So that one goes back many, many months. And I'll bet you if you pull up the VIX, you'll find it exploding on that downturn. So what you see when you look at the VIX is you find out that when the market goes down, the VIX goes up. And when the market goes up, the VIX goes down. So this VIX isn't a real volatility gauge. Now, it's quite possible, and we saw this in 2008. I actually pointed it out at the time that we had tremendous range expansion. So based on the VIX alone, just based on the Black-Scholes model, based on volatility, not based on what people think the Fed's going to do, because that's, remember, that's fundamentals. VIX is strictly technical analysis. We're not talking about fundamentals. We're not talking about the Fed putting their foot down on the gas. We're talking about what could happen in the future based on what's happened. So based on this volatility, we could very easily get some big drop that goes down. Let's try to get this drawn here. So like this. This volatility here actually implies a potential volatility down to there. That's the kind of thing that we saw on the financial crisis when we got a range expansion. You see it here. It's not really clear. It's not as dramatic, but it started happening with bouncing up and down. You saw it here. So that would indicate to you that the VIX should be rising. In other words, even though the market has turned around and is rising, the VIX should still be rising. Well, it's not. The VIX is falling dramatically. So this VIX, whatever it is and however it's calculated, is really just a mirror image of the Dow Industrial Average. And you can see that here. When the Dow goes up, the VIX goes down. When the Dow goes down, the VIX goes up. That's all it is. It's a mirror image of the stock market. So it's a completely useless indicator, and it's meaningless. So what is really going on in the stock market? Well, what is really going on in the stock market is that it started to top out, and the Fed panicked. That's the bottom line. And the big question is going to be now, where are we going to go from here? Because you can see that just with a little bit of talking and then the ECB coming out and doing their thing, that we're rallying dramatically. Some would say this is very, very bullish. I would say no, it's actually very, very bearish, because it shows you how ridiculously unstable this market is. That the market can react to rumor in such a dramatic way tells me that this market is very vulnerable to any kind of reality. I've drawn the trend lines in. We had the violation of the most recent trend line very clearly right there, and you can see we have this snapback recovery way up above it. So the central banks of the world are dedicated to printing money, There's no question about it. They are tied to the hip to the equities markets. Now, the reason why that is because everybody is invested in these markets. I've gone through the numbers before. The number of dollars that are in gold and silver now, I believe the traditional figures, this is just off the top of my head, but traditionally through the 50s, 60s, 70s, 80s, the number that most money managers would recommend is roughly 10% of your portfolio, and that's just your conservative hedging type of thing. The latest figures I've seen are around 0.5%. So we're down 20-fold from what is normal. And I would contend that what is normal should not be, in dangerous times, should not be your allocation. In my opinion, your allocation should be at least a quarter silver and a quarter gold and maybe a quarter cash and a quarter something else. I don't know what that should be. But so we're down around 0.5% allocation for the metals. And that sets us up for a tremendous crash in the stocks. Now, as I pointed out before, Jesse Livermore, who was the greatest stock trader of all time, also the greatest technical analyst and probably one of the greatest fundamental analysts as well, he told us that when the bull market is going out and the bear is coming in, what you have is you have the leaders that they will start to roll over. So we want to take a look at some of these leaders. Now, the one I've followed for quite a while, of course, is going to be Priceline. And Priceline is actually doing a bounce similar. You can see, let's get this indicator off of here. Priceline is doing something similar to what the transports is doing. Not nearly as dramatic. But you can see here that Priceline, this is a stock that's going to crash. I can't tell you when it's going to crash. I can just tell you it's going to crash. And because the stock has gone up parabolically. Once it's gone up parabolically and failed, that happened here. It's happened a number of times. You actually had it happen once, twice, 3 times. Is the 4th time a charm? I have no idea. But I know that at some point it's going to crash. We don't know where it's going to correct back to. Now, another high flyer is Chipotle Mexican Grill. This one I think is vulnerable for a number of reasons, and one might be a potential Ebola scare. So you can see on the daily here that this stock had this very bizarre, this is called an island reversal, and this is where you have this floating island where it gaps up and then it's gaps back down. That's a very bearish formation. So you can see these leaders rolling over. Now this one isn't nearly as dramatic percentage-wise, but still at the bottom. And this is here's your Barack Obama bottom right here at about 36 bucks, and we're up to 675 bucks. So ridiculous gains, and trees don't grow to the sky. Now there's a comment on the YouTube channel on the recent video that I posted about my talking about stocks go to zero, and a person questioning that. Well, stocks are an ownership percentage in a company. Why would you say that they would go to zero? Well, you have to remember that these stocks are added and taken out of these indices on a regular basis. So, for example, in the 1929 crash, a lot of the companies, we had, I think at one point there was 1,000 car companies in this country, some ridiculous number, I don't remember, maybe it was hundreds. A huge number of them went bankrupt. Stutz, Bearcat, etc., etc. They were all taken out of the averages. So these are removed from the averages. Now, this is GT Advanced Technologies. I covered this. This is the Apple supplier. All of a sudden just went bust. This is what happens to stocks. This is what can happen to stocks at any moment. How are you going to get out when a stock gaps down like that? Now, you can have your stops put in place to trigger you. Well, guess what? If the stock gaps down, then the first price it trades at is where you get filled. Let's say you have your stop at 14.5, 15 bucks here. You're not going to get filled there. You're going to get filled down here. With this one, you might have a $10 stop. Well, guess what? You're going to get filled at 2 bucks because that's where it opened. So stocks are much more risky than people believe. And there's all other factors that we haven't even covered. We've talked about it in the past. There is the DTCC, the fact that these stocks are held in street name, the fact that you don't take delivery of the shares. Even if you do take delivery of the shares, you don't know if those shares are counterfeited and diluted, so you really don't know what percentage you own. We know that the CEOs and these other people pump up the price of the stock to a top. They unload their shares, crash the stock. So the whole thing is really a very dangerous game to play. It should only be played with play money, money that is left over after you have covered all of your preps, your food, your water, your survival supplies and first aid and all that stuff, any fuel and debts paid off, physical gold and silver stacked, and then way down the list is playing paper stocks and trading maybe to make a profit so you can stack more gold and silver. So the VIX at this point is a meaningless index. It doesn't really mean anything at this point. It just means that it's a mirror image of the stock market. When the stock market goes up, the VIX goes down. When the stock market goes down, the VIX goes up. And the market now is completely controlled by the Federal Reserve. The Federal Reserve just blinked. So what we want to watch is the all-time high in these. And if we had a real VIX, if we had a real volatility index, what that index would say is it would be very high right now, because based on this insane activity that we've had, it's quite possible that a few days from now we could be up here, but it's also quite possible that a few days from now we could be down here. So volatility is actually increasing regardless of what the VIX says. And we'll talk to you next time.